Hi, David here from Critical Trading. So I've recently closed one of my stock trades that I shared in one of my previous videos. I bought here, which is where most retail traders were selling, at a false breakout that was taking place in the planned support level, which was an area of low accumulated volume, making it a high probability entry. And I've closed this trade over here. Now, as you can see, market did exactly what I anticipated and my position has gone into profit straight away. However, market then reversed and went back to this area, eliminating all open profit I've accumulated since opening this trade. Market then traded around my break-even point for some time, and only after that, it has rallied towards my profit target. The development of this trade is a great example of how important the size of your profit targets is, and so in this video I'm going to give you two things that are absolutely critical to consider when deciding how big your profit targets should be. Number one thing you have to consider when it comes to the size of your profit targets is your entry strategy. Now, what do I mean by that? Well, let's discuss two different types of trading strategies. The first one is a mean reversion strategy, which aims to take advantage of small reversals in the markets. An approach like this typically has higher frequency of signals, but these tend to be of a smaller potential. In that case, it makes sense to combine such entry technique with smaller targets at around the same size as your stops. A massive profit target that is, say, 5 times bigger than your stop loss just doesn't make sense. In fact, using profit target that big when trading minor reversals will likely have a detrimental effect on your strategy, as the target size is just not aligned with the entry logic, which trades minor price reversals. In that case, win rate would be negatively affected, so would be other important performance metrics. The second strategy type is a trend-following strategy, which aims to take advantage of moves that are less frequent but have bigger potential in terms of their size and length. In this case, it makes sense to use targets that are, say, 3 times the size of the stop loss. The frequency of the signals will generally be lower when compared to the mean reversion approach, and so it is vital to try to get as much as possible out of every single trading signal. When it comes to my strategy, I generally would say it's a hybrid between a mean reversion and trend following. Now, this is because we look for quick price reversals caused by temporary change in the dynamics of the supply and demand. And so the logic of our entries falls into the first group of strategies I just mentioned, which is mean reversion. However, we aim to time our entries into a suitable overall context of the market. In the case of this particular long trade, the context is a long-term uptrend. When it comes to the profit target I decided to use on this trade, this was placed slightly further from the entry to try to capitalize on the market continuing in its long-term uptrend and testing its previous long-term high. So my recommendation here is to think about what is the logic of your entries first. Do you trade short-term reversals, or does your approach aim to catch lower and bigger moves? After you manage to conclude this, you need to think about what size of targets it makes sense to use to match your entries. Now, I said that in general, a trend-following approach would aim for big profit targets in the range starting from, say, 3 times bigger the size of the stop loss. This typically goes hand in hand with a win rate of about 40%, which is something that may not be suitable for everyone. And that leads me to the second point. So what is the second thing you must consider when it comes to the size of your targets? It's your personality and experience. Before we get to that though, make sure to go to criticaltrading.com and get a copy of my free ebook if you haven't done so already. This is a short guide in which I discuss typical mistakes done by most beginners in this business and how to make sure that you do things differently to give yourself as high odds as possible. Click the link on the screen and download it for free now. So going back to the second point, what do I mean by considering your personality when determining what size of targets should you use? It's simple. I'm saying that some traders want to hold their trades for short periods of time and close them as soon as possible, and some actually prefer to hold their trades for a longer time with higher potential reward. This is something that's not talked about very often as it's not clear in historical backtests, but as soon as you start risking real money in the markets, you will see various patterns popping up that you weren't necessarily aware of in the first place. If you already have some experience in trading, then you likely relate to this. One of such patterns may be that you are not comfortable with holding your open position for longer periods of time when aiming for a big target that's too far away from your entry. You may notice that you prefer to close the trade as soon as possible. In that case, even a profitable trend following system with high risk to reward ratio will be of no use, And you should consider switching to a different approach, one that would have higher trade frequency relative to your time frame, but would aim for smaller targets. This is one of the reasons as to why there are so many strategies with amazing historical backtested results, but as soon as these are executed manually by people to whom they do not really fit on a personality level, then the live results are completely different to what was expected. Look at my trade here. I've entered here, but because I aimed for a profit target that was relatively far from my entry, I had to withstand this reversal, followed by this reversal, and then finally this third reversal here that's completely eliminated all my accumulated profit. I've had to wait with my position open to see the trade coming back to the break even after a relatively long time after the entry. And this is not something that's suitable for everyone. You need to ask yourself if you would be okay to do the same. Would you be able to sit and wait while all your open profit is being eliminated and the position goes to break-even point? If not, then an obvious solution here is to aim for smaller profit targets instead, shorten your average position hold time, and increase the trade frequency. This especially applies to day trading, which makes this even more difficult as you watch the chart with the real-time ticking data. When it comes to the swing trading, it is easier as one doesn't have to be watching markets throughout the day. I swing trade and I only look at the charts twice a day, at the open and at the close. All this is closely related to your trading experience as well. Experienced trader who's got hundreds of trades under his belt can aim for bigger targets as he's able to mentally withstand pullbacks against his position. If you're just starting out, I don't think it's wise to try doing the same. My advice here is to start with small targets at around the same size as your stop losses and learn to execute your entry signals first. Only after you're confident with your entry signals should you start looking into increasing the size of your profit targets. Thanks for watching. If you like this video, then please do me a favor, hit the like button and subscribe to my channel. Also, please let me know what you think in the comments. This is David, Critical Trading, signing out.